If your spare cash can earn interest, should it sit in a high-yield savings account, or should you buy short-term Treasury bills instead? The answer is not just whichever number looks bigger today. This choice is really about four things at once: how much interest you keep, how quickly you can get the money, how the taxes work, and how much hassle you are willing to accept for a small difference in return. For years, many people treated savings accounts as boring parking lots for cash. Then, cash started paying noticeable interest again, and suddenly a question became common. If a bank pays one rate and the government pays another, which one is actually better? Before comparing products, ask what job this money has. Money for rent next week has a different job than money you might use in 6 months. Emergency money has a different job than cash waiting for an investment opportunity. A high-yield savings account is still a bank account. You deposit dollars, the bank pays interest, and you can usually move money back to checking without selling anything. The high-yield part simply means the account pays more than many traditional savings accounts. A Treasury bill is different. You are lending money to the US government for a short period. Bills are usually sold for less than their face value. At maturity, the government pays the full face value, and the difference is your return. This is where comparisons get messy. Savings accounts usually advertise an annual percentage yield. Treasury bills may show auction rates, investment rates, or yields on a brokerage screen. Those numbers are related, but they are not always presented in the same format. For a beginner, the simplest question is this: after fees, taxes, and timing, how many dollars will I actually keep over the period I need this cash? A slightly higher quoted yield can disappear if it creates tax friction, delay, or confusion. A high-yield savings account is flexible, but the rate is also flexible. The bank can raise or lower the rate over time. That is not necessarily bad. It just means today's attractive rate is not a promise for the next 6 months. A Treasury bill locks in the return if you hold it to maturity. If you buy a 4-week or 13-week bill and hold it until it matures, you know the ending value. But your cash is tied to that maturity date unless you sell or transfer it. Liquidity means how easily cash becomes spendable cash. A savings account is usually very liquid. You transfer money and it is ready relatively quickly. A Treasury bill is liquid in a market sense, but not always liquid in a life happens this afternoon sense. If this is your first emergency fund, convenience matters a lot. The best emergency cash is boring, visible, and reachable. A higher return is nice, but not if the money is awkward to access when the car breaks down or a bill is due. If this kind of calm money breakdown is useful, consider subscribing. The goal here is not to chase tiny rate differences. It is to understand the trade-offs so your cash has the right job in the right place for the right reason. People often say both options are safe, but safe means different things. A bank account has deposit insurance when it is at an FDIC-insured bank and within the coverage limits. Treasury bills are obligations of the US government. FDIC insurance generally protects up to $250,000 per depositor, per insured bank, per ownership category. That phrase matters. A person with money spread across different banks or account types may have different coverage than one large account at one bank. Treasury bills do not have FDIC insurance because they are not bank deposits. They are backed by the full faith and credit of the United States government. That is a different safety structure, and it is one reason many investors treat short-term treasuries as very low credit risk. Taxes can change the winner. Interest from a high-yield savings account is generally taxable as ordinary income at the federal level, and often at the state and local level. Treasury bill interest is federally taxable, but generally exempt from state and local income taxes. Imagine two options with similar quoted yields. If you live in a state with income tax, the Treasury bill may leave you with more after-tax income because of that state tax treatment. If you live in a state with no income tax, that advantage may not matter. The after-tax answer depends on your situation. Your federal tax bracket, your state tax rate, and the account type all matter. This is why two people can look at the same savings rate and the same treasury yield and make different reasonable choices. A savings account wins on simplicity. You can open it, deposit money, see the rate, and transfer cash when needed. There may be withdrawal limits, transfer delays, or bank rules, but the mental model is easy. It feels like cash because it behaves like cash. Treasury bills can be bought through Treasury Direct or through a brokerage. Neither path is impossible, but both require more attention than a savings account. You choose a maturity, place an order, wait for settlement, and decide what happens when the bill matures. Treasury Direct is direct with the government, but it is not built like a daily banking app. A brokerage may make buying and selling easier, but it adds its own interface, rules, and tax documents. The better tool depends on whether you value direct holding or day-to-day convenience. Settlement is the moment the trade actually completes. With a savings transfer, you think in terms of bank processing time. With a treasury bill, you think in terms of auction date, issue date, maturity date, and any sale process if you need out early. If you hold a treasury bill to maturity, the path is clean. If you need money before maturity, the path can be less clean. You may need to sell in the secondary market, and the price can be affected by current rates and platform rules. Short-term treasury bills usually have much less price movement than long-term bonds, but less is not zero. If rates move after you buy and you sell before maturity, the sale price can be a little different from what you expected. For many beginners, the bigger risk is not a dramatic market loss. It is matching the wrong tool to the wrong need. If money must be available immediately, a bill maturing in several weeks may feel safe on paper, but inconvenient in real life. A common mistake is chasing every tiny difference. Moving money from one account to another for a small extra yield can create login clutter, tax forms, transfer delays, and mistakes. Sometimes the extra dollars are worth it. Sometimes they are just noise. Suppose you have money you will not need for 3 months. A savings account offers flexibility every day. A 3-month treasury bill may offer a competitive return and possible state tax savings. The question is whether the extra return, if any, pays you enough for less flexibility. A high-yield savings account can make sense for your first layer of cash. Think rent money, near-term bills, emergency funds, and money that needs to move quickly. It is also useful when simplicity is more valuable than optimizing the final decimal point. Short-term treasury bills can make sense for cash with a known timeline. Maybe you need it in 1 month, 3 months, or 6 months. If you can wait until maturity, you may get a clear return, strong government backing, and favorable state tax treatment. Some people use a treasury bill ladder. Instead of putting all the cash into one maturity, they spread it across several short maturities. That way, some money comes due regularly. A ladder can improve access, but it still requires tracking and reinvestment decisions. There is another quiet trade-off. When a short bill matures, you have to decide what to do next. If new yields are lower, the next bill may pay less. Savings accounts have the same basic issue because banks can lower rates too. A high-yield savings account rate is not a loyalty reward. Banks compete for deposits, and rates can change. Some accounts stay competitive, while others quietly fall behind. If you use one, it is worth checking occasionally, not obsessively. Most of the time, the headline comparison focuses only on yield. But friction matters too. Look for account fees, minimums, transfer limits, auction schedules, brokerage details, and how easy it is to get records at tax time. The cleanest option is not always the highest quoted one. Buying an individual treasury bill is not the same as buying a treasury money market fund or a short-term bond fund. Funds can be convenient, but their yields, fees, tax reporting, and price behavior can differ. Similar ingredients do not always mean the same product. A practical approach is to separate cash by urgency. Keep immediate emergency money in a simple insured bank account. Consider Treasury bills for the portion with a clear timeline and no need for instant access. This is not about one perfect answer. It is about matching time to tool. The truth is that high-yield savings accounts and short-term Treasury bills are not enemies. They are cash tools with different strengths. Savings accounts win on everyday access and simplicity. Treasury bills can win on locked short-term returns and state tax treatment. The right choice depends on the job of the money. If you want, leave a comment with the cash decision you are trying to understand next. Should we break down money market funds, CDs, treasury ladders, or where emergency funds should actually sit? Your questions can help shape the next explainer.